Hello everyone. Banks and other creditors look into your credit score to decide whether you can qualify for a loan, mortgage, or other financing options, which is why having a high credit score is absolutely important. So let's review some practical steps to increase your credit score. Step 1. Pay your bills on time. Even if you cannot pay your bills in full, be sure to make the minimum payment. Contact your lender right away if you think you have trouble paying a bill. Don't skip a payment even if a bill is in dispute. Step 2. Monitor your credit card balances. Make sure you're not using too much of your available credit. Don't go over your credit limit. Use only a percentage of your available credit. And try to use less than 35% of your available credit. If you use a lot of your available credit, lenders see you as a greater risk. This is the case even if you pay your balance in full by the due date. To figure out how to best use your available credit, add up the credit limits from all your credit products. This includes credit cards, lines of credit, and loans. For example, if you have a credit card with a limit of $5,000 and a line of credit with a limit of $10,000, your available credit would be equal to $15,000. Try not to borrow more than 35% of the total credit limit, which in this case would be $5,250. Step 3. Increase your length of credit history. The longer you have a credit account open and in use, the better it is for your score. Your credit score may be lower if you have credit accounts that are relatively new. Consider keeping an older account open even if you don't need it. Use it from time to time to keep it active. Of course, make sure that there is no fee if the account is open, but you don't use it. Check your credit agreement to find out if there is a fee involved. Step 4. Don't close unused credit cards. Keeping unused credit cards open, as long as they are not costing you money in annual fees, is a smart strategy because closing an account may increase credit utilization ratio, which is a negative thing. In fact, if you owe the same amount on your credit cards but have fewer number of cards open, this may impact your credit utilization negatively and hence lower your credit score. Step 5. Don't mindlessly open new credit card accounts. Limit your number of credit card applications or credit checks. If you apply for a new credit card, make sure you don't do so too frequently. And don't do it before taking a large loan like a mortgage. This behavior may look irresponsible to creditors. It's normal and expected to seek credit every so often. When lenders and others ask a credit bureau for your credit report, it's recorded as an inquiry. If there are too many credit checks on your report, lenders may think you are urgently trying to get a credit or trying to live beyond your means. When it comes to credit cards, there are two types of inquiries: hard hits and soft hits. So let's take a look what the difference between the two are. Hard hits are credit checks that appear on your credit report and count towards your credit score. Anyone who views your credit report will see these inquiries. Examples of hard hits include an application for a credit card, some rental applications, or some employment applications. Soft hits, on the other hand, are credit checks that appear on your credit report, but only you can see them. These credit checks do not affect your credit score in any way. Examples of soft hits include requesting your own credit report or businesses asking for your credit report to update their records about an existing account you have with them. When you shop for a mortgage, auto, or personal loan, you can keep hard inquiries to a minimum by making rate comparisons within a short time period. Applications for the same type of loan within a designated time frame will only appear as a single hard inquiry. According to FICO, this span can vary from 14 to 45 days. Step 6. Use different types of credits. Your score may be lower if you only have one type of credit product, such as a credit card. It's better to have a mix of different types of credits, such as a credit card, a car loan, a line of credit, etc. A mix of credit products could improve your credit score, but make sure you can pay back any money you borrow. Otherwise, you could end up hurting your score by taking too much debt. Step 7. Alert banks and card companies when you move. You don't want to see your bills have gone unpaid because the mail didn't go to the correct address. So be sure to stay on top of your accounts and inform banks and other creditors about any change of address. Step 8. Check your accounts online. There's no reason for you to wait for the bills to come in the mail. You can access your accounts online, make sure your payments are all clearing and cards are being kept current. Step 9. Pay off delinquent bills. Paying down delinquent accounts would not remove any missed payments in the past from your report, but it can certainly make you look better to the creditors. And step 10. Look for inaccuracies. Sometimes information reported to the credit reporting agencies is not quite right or incomplete. The credit reporting agencies make it easy for you to dispute these inaccuracies. And remember, credit bureaus are just the messengers. It's up to you to let them know one of your creditors reported inaccurate information. Lastly, as a bonus content, here are some resources that you could use to check your credit score for free. The first resource, and the one that I personally use, is called Credit Karma. It is available both in US and Canada, and you can access the link online. The second resource is called credit.com, and lastly, the third version for residents in Canada is mogo.ca. There you have it, folks. 10 simple steps on how you can improve your credit score. We hope you found this video of value. If you did, please give us a thumbs up and share this video with a friend. And don't forget to join Moementum channel by subscribing to our channel. On Moementum, we post weekly videos about investing, finances, and personal development. Until next time.